It finally happened. I hardly noticed. All year I've been warning you that the flood of new IPOs would eventually derail many of those turbocharged growth stocks in the NASDAQ that we like so much. If you want to participate in a deal, you need to sell something, though. You have to sell something else. And lately, money managers have been selling the software as a service plays. Anything cloud-related has been slammed. I'm blaming the IPO market. When this year began, I was worried it would end up looking like the end of the dot-com era. Back in 2000, we had two markets. The NASDAQ Composites, which was filled with pretenders like InfoSpace and eToys and WorldCom and Global Crossing. And then there was the real market made up of the Coca-Colas and the Mercs. From 1999 to 2000, more than 350 companies came public, flooding the market with endless amounts of stock, both from the IPOs and from their secondary offerings. There was too much new supply and it only overwhelmed demand. Then the whole dot-com edifice came crashing down. Even the good ones, by the way, they all got eviscerated. And then Wall Street soured on things tech and rotated back to the Cokes and the Pepsis, the high-quality companies with consistent earnings and good dividends and buybacks. Only a half dozen companies really survived. Now, we're seeing something similar. The cloud stocks are being clubbed, though fortunately there aren't that many of them, at least not compared to the dot-com period. And some of the cloud names are even profitable. But it doesn't matter. Money's flowing back to consistent companies with healthy dividends as long as they don't have too much China exposure. That's what we've been seeing in the Dow. Once again, the new supply from IPOs has overwhelmed the natural demand from buyers. This happened sooner than I thought because there's a lot less demand for individual stocks than there used to be. These days, indexing has become the default way most people invest. Almost 60% of the money in the stock market comes via the indices. And the indices aren't allowed per se to participate in IPOs because they're not in the index. I mean, that's kind of what we don't want to have happen, isn't it? Wow. Plus, many of these junior growth companies like to issue stock as salary, which means there's a constant flood of additional supply. It's like weak shale underneath a skyscraper. It doesn't help that many of the IPOs are unicorns, and soon their lockups will start to expire. Do you know, forget this, Uber's lockup on its insider sales ends in a few weeks. We're going to get with $22 billion worth of stock. That's 4 times the current float. Thank you, Larry McDonald, for Bear Traps, for putting that work together. And Uber's hardly alone here. You put it all together, and this situation is just too darn similar to the dot-com unraveling. We don't want this, but it is. It's almost like the stock market's equivalent of Gresham's Law. Bad money's driving out the good. In this case, the weakness from unprofitable, newly public companies bleeds into the profitable but expensive cloud names. Did you see the way Peloton acted today? There were 5 firms that told you to buy it. Yeah, these one red-hot group of cloud stocks is really plummeting to earth. Oh, and the software outlook from Workday last week took everybody by surprise. So what do? If you don't own any of the cloud stocks, I think you got to let them settle. If you do own the higher quality cloud plays that are being brought down with the bad ones, you have my permission to pick at them into weakness. But please be mindful that the whole group is under pressure and could have a potentially lot more downside. I wish I could offer more reassurance, but the vast supply of new stock just snuck up on us, and it's causing the whole group to get hit. These IPOs are a tsunami, and it's just not worth trying to fight it. Better to get out of the way. Oh, the only piece of good news? At least we weren't annihilated by WeWork. The damage was according to the so-called professionals who got their lungs ripped out by an overly dynamic entrepreneur with a terrific story and a real bad balance sheet. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.